Hey everybody, this is Paul doing hopefully it should be a quick video. Just wanted to kind of go over some thoughts, just kind of show some things that are going on with the portfolio so far. Doing an update on the 14th as the market is closed right now. Um, just it's easier to do an appointment or a thing now to have like a dental thing going on now or tomorrow, so it's going to be impossible to talk. But so let's go over a few things that we got going here. And there we go. So that's the status of the portfolio right now. So this month, 3.07. So right now, up about 4% this month, which is pretty awesome. Almost 2.5 grand. And then for dividends, that's where we were. This is where we are now. I believe that is caused because I reduced positions in this part right here, and I'm going to explain what's going on there. So I reduced positions in two funds that were tech focused, I guess if you want to say. These two, I kept QYLD the same. That's just kind of doing its thing. So as it stands right now, the entire portfolio has dividend reinvestment turned back on, except for QYLD. I think that's about as large as I want to make that position. And I reduced the size of these two positions right there, so you can kind of see. This used to be mostly green, now it's just kind of like yellow and whatever. So what I wanted to go over is like what in the world is going on with the market? Like, where's like all this money coming from? Why is everything just all of a sudden just, not even a month ago everybody was talking about recession, 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 and now all of a sudden we're talking about like this just monster rally off the lows. So I guess what we need to kind of go over first is where we were compared to where we are now. Okay, so this is where we were prior to the Fed. So this is when the bad CPI print started really like, yeah, the Fed's going to have to do something about this. This day right here was the depth of transitory. That's when everybody stopped saying transitory and everybody started making fun of everybody who said transitory as if they weren't already. So this is the day that Team Transitory died. And that's the day we had inflation that you couldn't deny was going up. So then we had to start pricing in, okay, well, the Fed has to hike. What does that mean? Oh, well, it's not going to be that bad. They only got to do 25 basis points. Oh, no, they have to do 50 basis points. Well, that's not good. Then you get another CPI report, and it's just as bad. Oh, no, now we're at 75. Okay, now we're talking, instead of 50, we're talking 70, okay, or 75. And then everybody was like, well, that might be it. And then you get another inflation report, and then all of a sudden, oh no, we got to talk another 75. Oh God, we're 75. Oh, it's getting really tight in this place. Also, right about here, see this right here? This is quantitative easing. This is when the Fed was supposed to start getting rid of that very large balance sheet that they have, which is made up of U.S. Treasuries and mortgage-backed securities. Something interesting happened in June. They raised rates 75 basis points. They didn't reduce the balance sheet at all. That's one thing that has not been talked about at all. This was the plan, was that they were going to reduce. So it was supposed to add up to about 90 billion a month. So 30 billion in mortgage-backed securities, 60 billion in U.S. Treasuries. So the original plan was to do 45 billion, 45 billion, 45 billion, which is 135 or so. And then they were going to go into the big numbers. None of this has actually happened. Their balance sheet is maybe like $8 billion smaller. There's some things that have termed off, but it's not 135 billion. Like, that just hasn't flooded the market. So what in the world's going on here? The best guess that I've seen anybody give is that in June, when they were raising rates and they were also talking about reducing the balance sheet, the credit markets themselves, the things that handle credit, ground to a halt. Those are the things like high debt companies really rely on to stay in business. So like the Carnivals of the world, you can tell, and you can just see it in these stocks. The Carnivals, like the CCLs of the world, right here. The trash meme stuff. anything that relies on a lot of debt. So if we go back here, you can see kind of bottom out, and it was headed to a very bad place. And you can tell that the credit markets were just starting to kind of grind to a halt because the amount of credit offerings were just coming to zero. Everything was starting to just really stop. Then you get a few inflation, or you get a few GDP reports that come in negative, and then all of a sudden you have that narrative. Credit markets coming to a halt. GD reports coming in negative. Everybody jumps in on one side of the boat, which is the sell side. Here's where that backfires, and nobody could have predicted this because I think I had something that was like, I thought it was going to go for another leg lower. Like I thought we were going to have another big dip like this, maybe another 5. I've been telling everybody 5, 10, 15% is easy negative by the end of the year. What happened is we didn't get the QT part. And big thing, the jobs numbers keep going up. So if you go over to the where's the jobs numbers here? I keep copies of all this. So if you go to the jobs numbers, these are huge. These are massive numbers that just in theory shouldn't even be happening. So you can kind of see we've basically recovered all of the jobs pre-pandemic. So what's supposed to be happening in the bear everything's about to end narrative, which is basically we do something like this and then we drop another 10%, is the earnings reports for June and July were supposed to come in horrible. So earning reports across the board were supposed to be horrible. The jobs numbers, so these JOLTS reports, like the amount of job openings, these were supposed to collapse. There's still 10 million open jobs. This right here, this jobs report, this should not be possible right now if you believe the bear narrative. So what's supposed to happen is 3 things are supposed to collapse: earnings, jobs, and then job openings. This is all supposed to be collapsing right now, which is the exact opposite of what's happening. And this is the disconnect between the market that relies on very easy money to keep going and the real economy that does rely on rates, but normal people are used to paying higher rates. Now the housing market, without a doubt, is certainly getting just hammered right now. This is I forgot what this one was, but it's so this is how so like everybody was saying recession. These are the 6 things that NBER, the economists, the economists that actually call something a recession, these are the things they look at, and every single thing that they look at was positive. So what's where are we going? What's going on here? So there's a theory right now that once they're expecting kind of like, so in September 15th, we're expecting a 75 basis hike. If you look at the market, that's priced in, but the inflation data came in lower because of energy charges. Also, with this going on right here, the market is still expecting quantitative tightening, which has been barely talked about, and that's when they push a lot of money in the bonds. So we could see this. So some are thinking that this is going to go to 3.4. I don't think that breaks the market. Some wanted to go much, much, much higher, and if you notice, the 2 is way above the 10, and the 10 was about to invert with the 10-year, or the 3-month right here was about to invert with the 10-year, which is like red flag central for a recession, and it never happened. So where are we going? So we're gonna on September 15th, we're gonna get the rate hike for sure. 75. I believe that's going to happen. Every single Fed speaker has been very clear that we're getting another 75. Are they going to do QT? When does this start? This is like the big thing that's like can basically just kill this market rally right here and turn this into, so instead of this being a recovery, because right now if this has recovered to key technical levels, and if you look at it the way the technicians look at it, is once it passes a certain point, so once it recovers 50% of its losses and it goes past 50% of its losses, everybody's been looking at this all the way back to 1960. That has meant the bear market is over. There's your recession right there. Boom, boom. I guess recession, I don't know. Or we didn't even enter a recession, or maybe we did, but those economist guys will determine that. But once you recover more than 50% of your losses, you're out of a recession. But here's the thing, rates are still very high right now. So rates are still very high. We've also got the Fed talking about making rates even higher. And you've also got QT, quantitative tightening, where they're trying to get rid of these different things at some point. So the way I'm dealing with that in my portfolio, so the only way you can deal with this in your portfolio is figure out what your long term. So as you can obviously see, I have been adding exclusively, almost exclusively, to this part of the portfolio right here. I've been adding a few into AFB, the municipal bond part, which I talked about before. I don't think I've added a few to O. I've definitely added positions to O, but majority of my positions have been in my long-term positions, as you can see here. Some to O. I think I added a little bit to main, but a majority there, a little bit here, and a very large majority here. And that's pretty much any income I have coming in. So if I got, like, say, VA money coming in, if I have DoorDash money coming in, all of it is getting dumped into my long-term portfolio right now. And I have a lot of DoorDash money coming in because I'm working, like, I'm grinding hard trying to get DoorDash money in there. Because if this does turn out to be a bottom, hey, there we go, right? There's your bottom. Still, I can get into some of these positions, very good prices. There we go. If this turns out to be another dump where we get this, my portfolio matched the market because these positions were large parts of it. I didn't start to suffer in my portfolio until I went into tech, and I timed the tech bottom at a very bad time. I thought tech had bottomed like around here, right around there. That's when I thought tech had bottomed, and as you can obviously see, it went much lower. And you can see that in my portfolio too. If I kind of sort this into losses and whatever, Intel, BSTZ, that's tech. QYLD, obviously, that's tech. This right here, that's tech. The rest of these, like, AT&T, this is a high debt company exposed to interest rates. So lower interest rates, good for utilities. Good for AT&T especially because they're still trying to recover from all the debt that they got throughout the years, making bad deals. Caterpillar, this is exposed to worldwide manufacturing, which is slowing down. And then if you look at the rest of it, there's where we're at. So what I reduced exposure to is tech, and I'm not trying to add too much exposure to any more tech because the Fed is still raising rates and they're going to do QT. QT is basically a form of rate hikes because they have to have somebody who will pay for those bonds when they try to dump them into the market. And bond traders don't buy things for free. So that's where we're at right there. So where can the market be? I still have to put that warning out there, just as I put the last warning out there. It could still be down 10 to 15% by the end of the year. The bears could still end up being right. Right now, I'm using this opportunity with this money coming in from like the DoorDash thing and just trying to put money there. I use that to do some dental work that I've been putting off for 30 years, give or take a little. That needed to get done, so I'm working on that right now. Right now, majority, about 3/4 of my money goes towards the portfolio, as you can obviously see. And then if you want to get a general idea where we're at, and I plan on adding more money tomorrow. So between July 1st and August 15th, I've added, what is that, about $12,000 to the portfolio, or it's just had market gains of that much. So that's where we're at right now. Like I said, my big focus right now is adding to the long term. The big focus is long term. And as you can see, the long term number is very soon going to pass the discretionary income number, which is this number here. And yeah, there we go. That's where we're at right now. But that's kind of what you can kind of expect. Like the only thing that's kind of on the table right now is really nothing in between now and September. We're waiting one more inflation report, one more jobs report, but the jobs report should come in positive. But the inflation report's going to be the next one. If the next inflation report is lower than this one, this market will rally, and the bears could end up being very wrong. But we need to keep seeing the numbers. The Fed is, I believe the Fed when they say they're going to keep hiking until inflation is much, much lower, and they're killing the housing market at the moment. So, but that's kind of where we're at right now. If you have any questions, just let me know in the comments, obviously. And then that's where we're kind of going from here. Thank you so much. Have a nice day.